So we are now doing the question for May 2015, question number 2, part C. Question number 2, part C. So the question reads that Lemi Limited is currently issuing 9% bond redeemable at links 100 par value. Redeemable at links 100 par value in 5 years' time. Alternatively, each bond may be converted on that date into 20 ordinary shares of the company. The current market price per share is 4.45, and these are expected to grow at a rate of 6.5% per annum for the foreseeable future. So the company's cost of debt is 7% per annum. So required, Roman letter 1, they wanted you to calculate market value of the bond. Roman letter 2, floor value of the bond. Roman letter 3, the conversion premium. So we start off with the Roman letter 1, how to get the market value of the bond. So we start with the Roman letter 1, which is market value of the bond. So first, I would like us to write something brief about what we mean by the market value of the bond. So you write that, that's now the market value of the bond. You write that it is the value of the bond. It is the value of the bond. It is the value of the bond where maturity value. It is the value of the bond where the maturity value is adjusted, to reflect the current conditions in the market. It is the value of the bond where the maturity value is adjusted to reflect the current conditions in the market. So let us now see how to get the market value for that bond. So we had said that value of the bond it is supposed to be given by present value of the interest. Then you add the present value of the maturity value. So to get the value for the bond, you simply get present value of the interest, then you add present value of the maturity value. So we start off with the interest. We now compute the interest. We calculate the interest. So interest was given where you are given the interest rate of 9%. So you get 9% of 100. We get 9% of 100. So what should be 9% of 100? That should be 9. And then after calculating the interest, we need to get the maturity value. We need to come up with the maturity value. So to calculate the maturity value, we should be able to get the market price per share in year 5. We need to get market price per share in year 5. We are doing the question for May 2015. May 2015, question 2, part C. So to get the market price per share in year 5, take the current market price, which is 4.45. 4.45, then 1 plus the growth rate. It is supposed to grow at a rate of 6.5%. 6.5% is the same as 0.065. So it is for 5 years in year 5. So compute that figure, then you give me that market price per share after 5 years. so that we get the market price per share after the 5 years. So when you calculate, it's giving us which figure? When you increase 4.45 by 6.5% for the next 3 years, so for the next 5 years. Someone has given me 6.1. How about the others? Others are getting which figure? Anyone else who has computed? I'm waiting for someone else that we compare, whether it is the same. Yeah, so now after that, they had said that that share was converted. So I'm getting 6, they are getting 6.1. So they had said that that bond was converted. It was converted into 20 ordinary shares. So to get the maturity value, now get 20 ordinary shares multiplied by 6.1. You take the 20 ordinary shares, you multiply it by 61. So when you do that, what should it be? Now the maturity value. When you multiply 20 by 6.1, what should be that maturity value? What should be that maturity value? So you are getting 122. So present value of the interest. Present value for the interest, you simply take the annuity multiplied by the present value interest factor for the annuity. Present value interest factor for the annuity. So the cost of capital was given in the question. It is 7%. So it will be 7% for the 5 years, because it is meant to be redeemed after 5 years. So interest, we got 9. So simply confirm to me what is 7% in year 5. You confirm for me what is 7% in year 5. In the annuity table, 7% in year 5 in the annuity table is which figure? 7% in year 5 in the annuity table. What value do you have in your tables? 4.1, 4.1002. Then we also add present value of the maturity value. So to get the present value for the maturity value, you simply take that figure of 122, we discount it at the present value interest factor, 7% year 5. So that is the same as 122. You confirm 7% in year 5 in the single period table. You confirm what is there as 7% in year 5 in the single period table. So anyone to confirm for me that figure? It should be 0. What? Anyone to confirm it is 0.7130. So 0.7130. So when you add them together, that is now what will give you the value of the bond. That is now value of the bond. That is what will give you the value for the bond. that is now what is giving you the value of the bond. So that is what is giving you the value of the bond. So what should be the value for that bond? That is now our Roman letter 1. That is now our Roman letter 1. So let us now go to Roman letter 2. We go to the Roman letter 2, where they were asking you to calculate the floor value of the bond. Let us also check what we mean by the floor value of the bond. So we can summarize that. We can write something brief about the floor value of the bond. We note that it is the value of the bond. It is the value of the bond. It is the value of the bond when the maturity value, it is the value of the bond when the maturity value, when the maturity value is the same as, when the maturity value is the same as the bar value or the face value of the bond. When the maturity value is the same as the bar value or simply the face value of the bond. The bar value or the face value of the bond. So for this question, all the details will remain, but the only change is maturity value. So you repeat everything the way we have done, but this part is not there. So maturity value is the same as the bar value of the bond, which was 100. So you repeat, these others are not changing. Only change this value to 100. Also change this one to 100. Then get the value of the bond afresh. That's now the floor value of the bond. It is simply the value of the bond where the maturity value is the same as the bar value. So you repeat all that I've done, but where there's the maturity value, change it to the bar value, which is 100. You repeat all this, then get now the value for the bond from there, because that's now to mean by the floor value of the bond. The only difference between the floor value and the market value is simply that part of the maturity value. So we can now go to the Roman letter 3. Roman letter 3, they were asking to get the conversion premium. The conversion premium per share. So to compute the conversion premium, when you want to come up with the conversion premium, and you want to compute what is supposed to be the conversion premium. So conversion premium is supposed to be equal to conversion premium. You simply take the market value of the bond, you get the market value of the bond. Then you subtract the current conversion value, divide by the current conversion value. So to get the current conversion value, to get the current conversion value should be equal to, you simply take the number of the ordinary shares multiplied by the current market price per share. So number of the ordinary shares are 20 multiplied by 4.45. 4.45. So you take 20 multiplied by 4.45. Get 89. So once you have done that, you now get the conversion premium. Conversion premium per share. So conversion premium per share, you calculated the market value. Market value, you got 120 what? You have seen like 123. So you take 123, it was 123.89. 89. So now subtract 89, but divide by 20 ordinary shares to get per share. Remember to divide by 20 ordinary shares to get per share. Remember to divide by the 20 ordinary shares to get per share. 20 ordinary shares to get per share. Remember to divide by the 20 ordinary shares to get per share. So that is now the end of that question. So did we do the one for September 2021? Confirm in your notes whether we had done the one for September 2021. Yeah, so that now concludes that topic for valuation. That now concludes that particular topic for valuation. So now we start a new topic, which should be cost of capital. We now start a new topic, which is meant to be the cost of capital. We now start a new topic, which is supposed to be now the cost of capital. So we start a new topic as the cost of capital. So under the cost of capital, we can write that this is the required rate of return by investors. It is the required rate of return by investors who have provided funds to the company. This is the required rate of return by investors who have provided funds to the company. Who have provided funds to the company. They include number one, cost of equity. They include number one, cost of equity. Number two, cost of the preference shares. So number two as the cost of the preference shares. Number three will be cost of debenture or bond. Number three should be the cost of the debenture or the bond. Number three should be the cost of the debenture or bond. So we start off with the number one, cost of equity. We start off with the number one as cost of equity. Cost of equity. So under the cost of equity, we summarize that equity refers to shareholders' funds. Equity refers to the shareholders' funds, and it is classified into two categories as follows. Equity refers to the shareholders' funds, and it is classified into two categories as follows. It is classified into three categories as follows. It is classified into three categories as follows. So we start with A as ordinary share capital. So A will be the ordinary share capital. A should be the ordinary share capital. So for the ordinary share capital, we write that the cost of the ordinary share is classified into two. The cost of the ordinary share is classified into two. The cost of the ordinary share is classified into two, depending on how dividends are paid as follows. The cost of the ordinary share is classified into two, depending on how the dividends are paid as follows. Depending on how dividends are paid as follows. Depending on how dividends are paid as follows. Depending on how dividends are paid as follows. So we start off with the Roman letter one. Roman letter one. Remember we talked about zero dividend. Zero dividend. Growth rate ordinary shares. Ordinary shares. Zero dividend growth rate ordinary shares. So for zero dividend growth rate ordinary shares, we calculate KE. So KE is now the cost of the ordinary share. What we did was the value. Now we are on the cost. So we want to get the cost of. So even when you check under the value, you simply make KE to be the subject. So we are making KE to be the subject. So KE will be given by D divided by P4. But this time we factor in the flotation cost, express it as a percentage. So to get the cost of the ordinary share with a zero dividend growth rate, KE is simply D divided by P4 minus F. Then you express it as a percent. So F is the flotation cost. PO is the current market price. PO is the current market price. D is the dividend. D is meant to be the dividend. That's now zero dividend growth rate ordinary shares. So number 2 will be constant dividend. Constant dividend growth rate ordinary shares. Growth rate ordinary shares. Constant dividend growth rate ordinary shares. So Roman letter 2 is constant dividend growth rate ordinary shares. The constant dividend growth rate ordinary shares. So KE will be given by D, then 1 plus G. So KE is supposed to be equal to DO, then 1 plus G divided by PO minus F. Then you add G like that, which is the same as D1 divided by PO minus F. Then you also add G like that. So to compute what is the constant to get our cost of the ordinary share. So you remember DO, we say it is the last dividend that was paid. Then we say D1 is the next dividend to be paid. F, we have said, is the flotation cost. G is the constant growth rate. G is meant to be the constant growth rate. G is meant to be the constant growth rate. So that is now about, in case it is constant dividend growth rate ordinary share. So that's now the first part, which is the cost of the ordinary share. Now we go to the retained earnings. We said equity was classified into two, ordinary shares and retained earnings. So let us now go to the retained earnings. We now go to the retained earnings. We should now go to the retained earnings. So when it comes to the retained earnings, we say that these are internal source of finance. These are internal source of finance, which will not incur the flotation cost. They are internal source of finance, which will not incur the flotation cost. Therefore, the cost of the retained earnings, is the same as the cost of the ordinary shares. Therefore, the cost of the retained earnings is the same as the cost of the ordinary shares, except that there will be no flotation costs. Is the same as the cost of the retained earnings, except that there will be no flotation costs. So we start with the Roman letter 1. So it is the same as what we have done for the ordinary share. The only difference, it has no flotation cost. So we start with the Roman letter 1, we have done, but now you write that in case of. So Roman letter 1 will now be, Roman letter 1, you indicate that in case of 0 dividend growth rate ordinary share. So this one you change to KR, the cost for the retained earnings will be KR, then less the flotation cost. Even the Roman letter 2, we say that in case of constant dividend growth rate ordinary share. So all of them will remain. We change this one to KR, then there is no flotation cost. So the cost for the retained earnings is the same as the cost for the ordinary share. The only difference, there will be no flotation cost. So it remained the same as the one for the ordinary share, except now there is no flotation cost. So that was about cost of equity. That was now about equity. So equity, we said it was classified into two, ordinary share and the retained earnings. So the one for the retained earnings is the same as the one for the ordinary share. The only difference, there is no flotation cost. Let us now go to number 2, which was cost of preference share, which is now meant to be the cost of the preference share. We now go to number 2, which was supposed to be cost of preference share, which was meant to be the cost of the preference share. So I'll only give you the formula because you already know what to mean by preference shares. So the cost for the preference share will be KB. It will be D divided by PO, then we minus F, then you express it like that. So KB is the cost of the preference share. So it is D divided by PO minus F, then you express it as a percentage. Remember, D is the dividend per share. The dividend per share, that is the dividend per share of that preference share. Then remember, F was the flotation cost. Then PO is the current market price. So there is only one item of the preference share. So we go now to number 3. which was cost of debenture or bond. We now got number 3 as cost of the debenture or the bond. The cost of the debenture or the bond. We now got the cost of debenture or the bond. So when it comes to the cost of debenture or bond, you write that it is classified into 2 categories as follows. It is classified into 2 categories as follows. It is classified into 2 categories as follows. It is classified into 3 categories, into 2 categories, into 2 categories as follows. So we start with Roman letter 1. Roman letter 1 as irredeemable debenture. Roman letter 1 will be irredeemable debenture. Irredeemable debenture. So under irredeemable debenture, we write that these are debentures which remains outstanding. These are debentures which remains outstanding as long as the company is a going concern. These are debentures which remains outstanding as long as the company is a going concern. As long as the company is a going concern. As long as the company is a going concern. So it is expressed as follows. It is expressed as follows. So KD will now be the cost of the debenture. It will be given by interest, then 1 minus the tax rate, the current value for the debenture. We subtract the flotation cost, then we express it as a percentage. So gain will be interest. So interest in the brackets of 1 minus the tax rate. Then this one is the current value of the debenture. VD is the current value for the debenture. Then you subtract F is still the flotation cost. So it is interest. This one is interest in the brackets of 1 minus the tax rate. Then we divide by the current value for the debenture. You subtract the flotation cost. Then you express it as a percentage. So that is Roman letter 1. Roman letter 2 is redeemable debenture. Roman letter 2 will be redeemable debenture. The Roman letter 2 will now be redeemable debenture. So under the redeemable debenture, we write that are those debentures with a defined maturity period. Are those debentures with a defined maturity period. Are those debentures with a defined maturity period. Their cost is equivalent to, yield to maturity. Their cost is equivalent to yield to maturity, is equivalent to the yield to maturity, and it will be expressed as follows. Their cost is equivalent to the yield to maturity, and it will be expressed as follows. Their cost is equivalent to the yield to maturity, and it will be expressed as follows. So now to get the cost of that debenture, it is the same as the yield to maturity. It is given by interest, then 1 minus the corporate tax. Then we add maturity value minus the current value, 1 over n. Then divide again by maturity value plus the current value multiplied by a half, express it as a percentage. So to compute KD or yield to maturity, it is simply equal to interest in the brackets of 1 minus the tax rate, then plus in brackets maturity value minus the current value 1 over n, then also divide by. So this one is the maturity value. This other one is the current value. So this is maturity value, this is the current value, the maturity value, and also the other one is the current value. Then n is the maturity period, where n is the maturity period. So n will simply be the maturity period. N is meant to be the maturity period. So n is what is supposed to be the maturity period. So from there, we should now get some questions in your past papers to see how to calculate. You can now get some questions from your past papers. So is it clear up to that point?
Should be interest add with 1 minus tax.
Sio plus. Yes. Interest is not a plus. This one is not a plus, it is interest, it is T. So we can go to a question for December 2012, question 2E. Get December 2012, question number 2E. December 2012, question number 2, part E. So we go to December 2012. December 2012, question number 2, part E. December 2012. So you go to page 90. When you go to page 90, you'll now get that question for December 2012, question number 2E. So that question 2, part E, it reads that Naziri Investment Limited currently sells bonds on shillings 1,200 with an 11% coupon rate, and shillings 1,000 per value. The bond agreement provides for the payment of interest. The bond agreement provides for payment of interest on an annual basis with 18 years maturity period. So required, they wanted you to calculate the bond yield to maturity. So the first thing you do in that part of the question is to calculate interest, is to compute interest. So interest is normally calculated on the bar value, and the interest rate is the coupon rate, where they gave you 11%, 11% of 1,000. So the bar value is 1,000. So 11% of 1,000 should be the same as 110. 11% of 1,000 should be the same as 110. Then maturity value, unless otherwise stated, it is always the bar value. Maturity value, unless otherwise stated, it will always be the bar value. So it will be the 1,000. So maturity value, unless otherwise stated, it is the same as the bar value. Then current value is given as 1,200. The current value is given as 1,200. The current value is 1,200. Then they were also able to give you N. N is the maturity period. N is the maturity period. They have given you 18 years. Are you able to see 18 years? So the question had no tax. When the tax is not given, you assume it is zero. Don't create your own. When the tax is not given, you assume it is zero. So now to compute your yield to maturity, take interest, which is 110. The question had no tax, we assume it is zero. Then we add maturity value is 1,000. Subtract 1,200. Then 1 over n, that's the same as 1 divided by 18. Then divide by 1 plus this one we multiply by a half, then express it as a percentage. So when you express it as a percentage, you are getting which figure? 8.99. Others online, you are getting which figure? Anyone who is online to give me the value? Online, you are getting which figures? 8.99. So the next question I want us to go to, let us also check June 2013, question 5B. We also go to June 2013, question number 5, part D. So we go to June 2013, question number 5, part D. June 2013. Question number 5, part D. The next sitting after this question, go to the next sitting. So we simply go to the next sitting. So in that next sitting, there is a question number 4. So question number 5. I say number 5 or number 4? 5, part C, part D. So the question reads that Everex Limited, mine is on page 88. You can see question 5D. Everex Limited has bonds which currently sells for shillings 11.50 with an 11% coupon interest rate and shillings 1,000 bar value. The bond pay interest annually. The bond pay interest annually and have 18 years to maturity, and it has 18 years to maturity. The company's tax rate is 13%. So required the current yield of the bond. Roman letter 2, yields to maturity of the bond. Roman letter 3, explain the relationship between calculated yield to maturity, current yield, and the coupon rate of the bond. So we start off with the Roman letter 1, which is supposed to be current yield of the bond. So to calculate the current yield, to get the current yield, it is simply given by interest per annum. You get interest per annum divided by the market value. Divide by the market value. Then you show it as a percentage. So you simply take the interest per annum, divide by the market value, then you express it as a percentage. So you start by getting the interest per annum. So interest per annum, what you do, the question gave you the coupon rate. The coupon rate is 11%. So you get 11% of the par value. 11% of the par value is 1,000. So this is the same as 110. That would be the same as 110. Then the market value was 11. Are you able to see 11? Sorry. The market value tumepatiwa that they currently sell for how much? 11.50. That's now the market value. So it currently sells at 11.50. So now your current yield, you simply take that 110, which is the interest, divide by the market value, which is 11.50. 11.50. Then you express it as a percentage. So then we get 9.57. Yeah, so now we go to the Roman letter 2. Roman letter 2, they wanted you to calculate the yield to maturity. So you go to the Roman letter 2, where you are to get the yield to maturity. So Roman letter 2 is meant to be yield to maturity. So to get the yield to maturity, it is supposed to be given by interest, then 1 minus the corporate tax, maturity value minus the current value, 1 over n. Also maturity value plus the current value. It's 1 multiplied by a half. Then you express it as a percentage. So we start off with the interest. So interest, it is 110. Therefore, we calculate it. Then this time the question gave you the tax rate. You can see the tax rate. So 30%. So maturity value, I say, unless otherwise stated, the same as what? The par value. And that par value is how much? 1,000. So subtract the current value for the debenture. You see 11.15. So n was also given as how many years? 18. So also divide by 1,000 plus 11.15 multiplied by a half. Express it as a percentage. you express it as a percentage. Others are getting which figure? So that is now our yield to maturity. So now we compare to make the comment in the Roman letter 3. So Roman letter 3, they were asking that explain the relationship between calculated yield to maturity, current yield, and the coupon rate. So let us see how we can deal with that. Let us now see how we can deal with that question. So we can check what is currently there, the coupon rate. So coupon rate was given as what percent? 11%. Current yield, you got which percent in the Roman letter 1? 5.7. Then yield to maturity, you have just calculated, you got which percent? So 6.39. So those are the items that we have. So then you remember the current value or the market price share. So market price was, so you can have the current value is 11.50. Then you remember the bar value. The bar value is 1,000. So from that information, we can make an interpretation out of that. So the first dash, you say that if the coupon rate is greater than the current yield, which is also greater than yields to maturity. So the first dash, you can say that if coupon rate is greater than the current yield, which is greater than the yield to maturity, then the bond is selling at a premium. Then the bond is selling at a premium. Then the bond is selling at a premium. So you see, it is selling at a higher price than above value. When that is the case, it is normally a premium. So that one can be explained by the information that we have. Then the second dash, now we say that if, now I'm reversing. So if the yield to maturity is greater than the current yield, which is greater than the coupon rate. So if yield to maturity is greater than the current yield, which is greater than the coupon rate, then the bond will sell at a discount. Then the bond will sell at a discount. Then the bond will sell at a discount. The bond will sell at a discount. Then another dash, we comment that if coupon rate is equal to the current yield, which is equal to yield to maturity. If the coupon rate is equal to current yield, which is equal to yield to maturity, then the bond will sell at par. Then the bond will sell at par. The bond will sell at par. So if the two of them will be the same, then it means the bond will be selling at par. The bond will be selling at par. So another question, let us also check May 2014, question number 2, part B. Now also check May 2014. There is a question number 2, part B. So go to May 2014. May 2014. Question number 2, part B. So when you go to May 2014, question number 2, part B, mine is on page 80. So when you go through that question, is saying about limited issued a new bond, issued a new bond 5 years ago. It issued a new bond 5 years ago. Then the bond was sold at par, which is 1,000, and has a coupon rate of 12% and a maturity of how many years? 30 years. Coupon payments are made semi-annually. The interest rate has gone down to what percent? 10%. So required from letter 1, the current price of the bond. From letter 2, they wanted you to come up with the current yield to maturity. Then finally, the capital gain on the bond. The capital gain on the bond. So we start off with the Roman letter 1, the current price of the bond. How to get the value for the bond. So we have seen from the previous topic how to get the value for the bond. From the previous topic, we have seen how to get the value of the bond. So value of the bond is supposed to be equal to value of the bond is supposed to be given by present value of interest. Then your present value of the maturity value. Present value of the maturity value. So to get the value for the bond, you simply come up with present value of the interest, then you add the present value of the maturity value. So we start off by doing some analysis. That bond was issued when? 5 years ago. But the bond was supposed to be there for how many years? So how many years are remaining? So to get N will be 25, but because it is being paid semi-annually, they pay twice in a year, isn't it? So multiplied by 25 by 2. Multiply 25 by 2 to get N. Remember, interest is paid semi-annually. So N will be 50. Then R, the interest rate. Interest rate is the same as the coupon rate. You see our coupon rate? Coupon rate is given as what percent? 12% is per annum, but they pay semi-annually. We divide by 2, which will give us which value? 6. Then cost of capital is that interest rate that was given. It has gone down to what percent? So the cost of capital, it is 10, but divide by 2 because it is paid semi-annually. Divide by 2, cost of capital, it is 10, divide by 2, which will give you what percent? It will be 5% like that. So now we compute interest. We calculate interest. So interest, simply get the 6% multiplied by the bar value. And remember, our bar value is how much? So what should be 6% of 1,000? Therefore, 60. Yeah, so now you get the present value of interest. Present value of interest should be equal to annuity multiplied by present value interest factor for the annuity. So that cost of capital is the 5% for 50 periods. For the 50 periods. So interest is the annuity. We got a figure of 60. So confirm in the annuity table. Confirm in the annuity table what is 5% in period 50. Just check what is 5% in period 50. What should be 5% in period 50? Yeah, should be 18.256 like that. So that's now the present value of the interest. Then there will also be the present value of the maturity value. There is also present value of the maturity value. So this one, you simply take the 1,000, then present value interest factor. Present value interest factor, that is 5% in period 50 because it only occurs once. So I said maturity value, unless otherwise stated, is the same as what? The bar value. So we take that bar value. Then also confirm now in the single period table. In the single period table, what should be 5% in period 50? Now you check in the other table. So it should be 0.1. Yeah, so now you will add those two figures. They should be able to give you what is supposed to be the value. So when you add them together, they should be able to give you the value. You have seen the 60. Yeah, interest is 60 shillings. Yeah. Because it is paid semi-annual. We took 12% divided by 2 to get the 6%. So that is now your Roman letter 1, the current price of the bond, or simply the value for the bond. So we go to the Roman letter 2. Roman letter 2 is supposed to be the current yield. So remember, it is current yield too, but the issue is the current yield, not to maturity. The issue is the current yield. So in the previous question, I've given the formula for the current yield. I've given in the formula for the current yield. It is the interest per annum. It is interest per annum. We divide by what? Market value. You express it as a percentage. So to calculate the current yield, it is simply interest per annum divided by the market value, express it as a percentage. So interest per annum, interest per annum. Now you take 12% of 1,000. Remember, it is per annum, not as per the question. You simply get the interest per annum. So that should give us 120. It will be 120. We'll get 120 like that. So now from there, you get your current yield, where you take that 120 divided by the market value. Market value, what how much? The value for that bond. 1182. 5, so expressed as a percentage. So that is now what is supposed to be your current yield. That is what will give you the current yield. Yeah. So now after that, you go to the Roman letter 3, which is supposed to be the capital gain or loss. How to get the capital gain or loss. So how to get the capital gain or loss. So capital gain or loss. So capital gain or loss. So to come up with the capital gain or loss. So capital gain will be equal to the current yield minus cost of capital. Simply subtract the cost of capital. So you take the current yield minus the cost of capital. So current yield, you say it was 10.15. Cost of capital is given as 10% per annum. You consider 10. Yeah. So the difference is what is meant to give you that element of the capital gain. So if it was negative, to be a capital loss, but this one is a capital gain. So we go to the last question on that area. I want us to check the question for November 2016, question 5. November 2016, we check question number 5. November 2016, question number 5. Yeah, so we go to page 60. There's a question for November 2016, question 5. So we start off with part A. We start off with part A. We start off with part A. So we start off with part A. So that part A, they wanted you to explain the following terms as used in the bond market. The following terms as used in the bond market. Roman letter 1 is yield to maturity. Roman letter 2 is the yield to call. Roman letter 2 is the yield to call. Roman letter 2 is meant to be the yield to call. The Roman letter 2 is meant to be the yield to call. So we start off with the Roman letter 1, which is supposed to be yield to maturity. We start off with the Roman letter 1, which is yield to maturity. So under the yield to maturity, we write that it is a measure of the bond rate of return. It is a measure of the bond rate of return. It is a measure of the bond rate of return that considers both the interest income, and any capital gain or loss. So it is a measure of the bond rate of return that considers both interest income and any capital gain or loss. That considers interest income and any capital gain or loss, i.e., it is the bond internal rate of return. It is the bond internal rate of return. It is the bond internal rate of return. Bond internal rate of return. So that's now what we mean by the yield to maturity. We go to Roman letter 2, the yield to call. Yield to call of the bond, yield to call of the bond. So when it comes to the yield to call of the bond, when it comes to the yield to call of the bond, we note that it is a measure. It is a measure of the bond rate of return. It is a measure of the bond rate of return. It is a measure of the bond rate of return, where the bond is redeemed or called, where the bond is redeemed or called, where the bond is redeemed or called before the maturity, where the bond is redeemed or called before maturity, and it considers interest income plus any capital gain or loss. It considers interest income plus any capital gain or loss. It considers interest income plus any capital gain or loss, up to the time of the call. It considers the interest income plus any capital gain or loss up to the time of the call, So that is now meant to be our A. So we go to part B. Which reads that Kanyoni Limited has issued shillings 10,000 bar value, has issued shillings 10,000 bar value, 10-year bond with a coupon rate of 12% per annum, with a coupon rate of 10%, 12% per annum. The bond is currently trading at shillings 830, and it is callable at 10,500 after 5 years. So the company will pay interest on its bond semi-annually. The company will pay interest on its bond semi-annually. So required, Roman letter 1, yield to maturity of the bond. Roman letter 1 is yield to maturity of the bond. Roman letter 2, yield to call of the bond. Yield to call of the bond. So we start off with the Roman letter 1, yield to maturity of the bond. We now compute the yield to maturity of the bond. So when you want to compute the yield to maturity of the bond, so yield to maturity of the bond. Remember, it was interest. It was meant to be interest, then 1 minus the corporate tax. Then we add maturity value minus the current value. 1 over n. Also divide by maturity value plus the current value multiplied by 1/2. Then express it as a percentage. So we start with n. N, it will be 10 years, but they say they pay 700. So interest was paid semi-annually, you can see before required. So take 10 years multiplied by 2. So that will be 20. Then interest is the coupon rate. Interest is the coupon rate. They are given us a coupon rate of what percent? So you take the divided by 2. It will give us 6%. So now from there, you calculate interest. So get 6%. 6% of the bar value. Bar value is 10 what? Are you able to see the 10,000? So this is the same as 600. Then maturity value, we say unless otherwise the same as what? The bar value, which is 10,000. Current value is 8,830. 8,830. Then cost of capital. The cost of capital, you are given what percent? So we shall not bother about cost, it's not given, and then it's not required. So N is given as 20 interest. So now we can calculate what should be the yield to maturity. So interest is 600. Corporate tax rate was given as what percent? It was not given. So we assume it is what? 0. So maturity value is the same as the bar value. Then you minus 830. 1 over 20, then is 20. Then we also divide by 10. This one you multiply by half. Express that figure as a percentage. Now express that value as a percentage. Now we require to express that value as a percentage. So you get 6.99, but we require per annum. So per annum, take 6.99 multiplied by 2. So because we require it per annum, so the figure you have calculated multiplied by 2. So because we require it per annum, the figure you have calculated multiplied by 2. So when you multiply by 2, what should we come up with? When you multiply by 2, what should you get? Because we require per annum. 13.9. Yeah, so multiplied by 2, because what you have calculated was semi-annual, but we require per annum. So multiplied by 2 to get per annum. multiplied by 2 to get per annum. Multiplied by 2 to get per annum. So that is now the yield to maturity. So Roman letter 2 is the yield to call. Roman letter 2 is meant to be the yield to call. So we go to the Roman letter 2 as the yield to call. So yield to call, the formula will not change. This formula will remain the same. Yields to call. Formula is the same. So what is changing are some few details there. What is changing is N. It was callable after how many years? So you take 5, but it was paid semi-annually to multiply by 2. Take 5, because it was payable semi-annually multiplied, which is going to be 10. So N will be 10. N will be 10. So interest is not affected because interest is calculated on the power value. Interest is not affected because it is calculated on what? Power value. So this value, maturity value is the callable value. Maturity value is the callable value. So it was callable at how much?
10.
So this one will be 10,500. So current value is not affected. This one is not affected. So what you are only changing is this maturity value to 10,500. Your N will also change to 10. Also this one, change it to 10,500. What is changing is maturity value and N. Maturity value and the N is what has changed. Because it was callable after 5 years. Then it was callable at 10,500. It was callable at 10,500. So now you can calculate those figures. You can now compute that value. You can now compute that particular value. Unapata which figure? Yeah, but I said you multiply by 2 to get per annum. Yes, all of them. So all of them multiplied by 2 to get per annum. Because even that one, still interest was paid semi-annually. The interest was paid semi-annually. So mmepata which percentage when you multiply by 2? 15.87. So that is now what should be our yield to call. So the next part of that topic, we need to know something brief about a subtopic as the weighted average cost of capital. Weighted average cost of capital. The weighted average cost of capital. Sorry? Sorry? Yes, this one is now a different one. So now we have combining the cost of the equity, cost of the ordinary share, and the cost of the bond. When you combine them, so there were the proportions that we were using, but now this one is still the topic of the cost of capital. So we are now on the weighted average cost of capital, or WACC. So that part, today we have another class at 2. Last time I took one, I said, yeah, so today when we meet at 2, we shall now go to that part because it is now almost 10. What we looked for that was the yield, the current yield. Yeah, it was the current yield. But this one we have been calculating the yield to maturity and the yield to call. In fact, the current yield, I said it is interest per annum. Even when it was paid semi-annually, we didn't use the interest for the 6 months. We used the interest for the year. Yeah, so you can see that part. Yeah, it was interest per annum. I didn't use the one for semi-annually. I said there were other part was semi-annually, but now for that particular one, I used the full year. Yeah. So that is now all for that. So when we meet at 2, we shall now go to the weighted average cost of capital. So once we finish that, I will give you some short notes on the ratios. Then I'll also give you some short questions on the same, so that we do now the last topic after we finish this one. There is that topic for the capital budgeting, net present value, internal rate of return, profitability index, like that. That will be now the last one. But it is not as complicated like the others. You see this one now you are able to follow. It's just something structured, not like the other one, where each had its own formula. But these ones are structured. You only need the format. Then you do any question on that. Yeah, so that's now for that level. So when we meet at 2, we shall now do this part of the weighted average cost of capital. So we can stop there for now. We must be able to be finishing because every theory